Good evening and welcome to the special broadcast. We're coming to you live from our ET Now studios in Mumbai. And of course, the news of the moment is that the US Fed has hiked its interest rate by 25 basis points. So as things stand, the benchmark rate now is at 0.75%. Well, as far as today's decision goes, remember there was really little room for speculation. A 25 basis point hike was pretty much priced in by the market with odds of a rate rise at 100%. Just to put things into perspective, this is the first rate hike that you've seen from the Fed this year, that's in 2016, and the second since the financial crisis. I've got with me a special panel: Hugh Galbert Johnson of Hugh Johnson Advisors, Nick Parsons of National Australia Bank, Punita Kumar Sinha of Pacific Paradigm Advisors, and TDS Securities. Priya Mishra joins in as well. All of you, thank you so much for taking time out for us. Nick, to you first. No surprises there. 25 basis point, pretty much in the price, wouldn't you say?
Interview as well, so I'm doing three different things. I've got a thing written.
Nick?
Nothing at the moment, just go through it and tell me your thoughts.
Punita, okay, Hugh, if you can hear me, this was more or less expected. The action clearly is going to be on what we hear Miss Yellen say, isn't it?
Oh, yes. Presumably you're asking me, and there's no question what we're going to be doing is focusing on what she has to say, because the real key is not that the Federal Reserve raised rates today, but it's obviously what are they going to do in 2017. We're going to get a little bit of an idea of her or the committee's assessment of the state of the U.S. economy, to include not only how's the economy doing, but also their expectations with regard to inflation. And a lot of that we're going to learn from her in her comments.
Do you suspect that the FOMC is going to alter its forecast for two rate hikes in 2017 today? Because, one would imagine that Ms. Yellen will perhaps play it safe and say that it's too soon to judge the economic impact of the Trump administration policies.
I don't think they're going to say much about the Trump policies. It's very clear from some of the comments that members of the Open Market Committee have said that they really don't know what indeed is going to be the impact of the Trump bump, or the Trump tax cuts and spending increases. They're trying to stay away from that subject. I don't know whether it's 3 or 4 times the next year, but I think it's probably they're going to really say once again that it's very heavily data dependent, and they'll just look at the data as it comes in to decide monetary policy or interest rate policy at every meeting. It's not going to be on a preset course. Believe me, it won't be on a preset course. We'll just have to review the data as it comes in, just the way that Janet Yellen is going to do it.
Right. Oh, of course, from what we understand, the policy seems to suggest that, the Fed is anticipating 3 rate hikes in 2017. Punita, if I could take this to you, your initial reactions about this 25 basis point hike, as we've been discussing, and, odds for now almost 2 weeks have been at 100 full percent. So I'm sure you're not surprised. But what about the pace of rate hikes in the coming year? The statement seems to suggest that 3 hikes are likely in 2017.
I think what is widely expected is actually not 3 rate hikes, but about 2 rate hikes in 2017. So I think if it is going to be 3, that is faster than people were expecting. And partly maybe because Janet Yellen ends her term at the end of next year, January of 2018, and she probably feels that she has some political pressure, perhaps, or she wants to leave the economy in a shape that she's comfortable with. So I think she might change that course over the next year, but I think the expectation is for 2, not.
Okay, so that's the Fed forecasting 3 rate hikes in 2017. Remember, that's actually up from the 2 that it had said in September. But let's talk about the fact that this is a decision that's coming in the wake of this post-election rally that we've seen, and of course the anticipation of a Trump White House. You did say that you don't expect Ms. Yellen to really address that in her press conference, but talk to us about how the street is rationalizing the kind of moves that we've seen for, Wall Street, the Dow, within distance of 20,000.
Yes, really good question. Here's the answer, I think, to the question. For a long time now, the Federal Reserve has complained that the responsibility for the U.S. economy has fallen completely on their shoulders. They've had to keep interest rates low and do quantitative easing. They've complained that there's been no fiscal stimulus in the form of tax cuts and spending increases. Question of timing, whether it'll be early in the year or whether it'll have to wait till the third quarter, but they're coming. So you're going to get the fiscal stimulus, and the street knows that, and knows that the fiscal stimulus is going to add to economic growth and improve earnings for 2017. So we're very optimistic we're going to get better earnings, but I think it's a little bit premature to expect that Janet Yellen is going to change her, or any members of the committee are going to change their forecast for the U.S. economy for 2017 and 18, because it's way too early. Even though the street is optimistic, it's way too early to try to quantify the impact of the Trump policy.
Do you agree with that, U.S. markets may be on a record run, but perhaps we're running a little ahead of ourselves here?
Well, my view is very clearly yes, but it's really hard to say. When I look at the numbers, when I look at the Trump plan, and I try to make a forecast for the economy and earnings, I'll be honest with you, I don't come up with strong enough earnings in a rising interest rate environment to justify the move we've had up in stock prices. So I think we're a little ahead of ourselves. We're pricey, we're overvalued, and I think investors this time, even though it's been really fun, have got to be a little bit cautious. I would be very cautious, very patient, and pick entry points which are lower than the current level. This thing has gotten a little bit ahead of itself, which is your question.
Punita, if I can ask you this, as somebody who's, spending a good part of her time in the United States, but you're also watching emerging markets very carefully. Would you agree with you that while you've seen Wall Street sort of run ahead of itself and some of this euphoria may be misplaced, the fact is that perhaps for a good part of 2017, we're going to see trade tilted towards DMs versus the emerging markets?
It depends on where you are actually sitting and who you're talking to. If you're in the US, then clearly here the allocators who allocate to different asset classes, including fund managers, are finding US a very solid place to be, because the recovery is happening, earnings are growing and improving, and the policies for the new government could be more business friendly. That might even further help earnings. So I think they would be more inclined to keep their allocations firmly in the US, and of course still stay allocated to emerging markets, but not rush in to allocate aggressively to emerging markets from here on. And of course, if you're sitting in Europe or you're sitting in another part of the world, then you would probably look at valuations and the currency impacts of a strengthening US dollar as well, and what that might do to emerging markets. So I would say yes. In summary, yes, the DM trade still seems to have momentum, but at some point, emerging market valuations might become the focus again. That may be maybe 6 months down the road, 3 to 6 months down the road.
Let's also welcome Nick Parsons on this discussion. Nick, unfortunately, we haven't been able to connect with you. I apologize for that. But, just to first get an initial reaction on what you've made of, the more or less foregone conclusion, the 25 basis point hike. What is interesting, though, is that Fed officials actually see 3 rate hikes in 2017 versus the 2 in September. Did that surprise you? Nick? Okay, I think we still can't speak with Nick. But let's go back to how you were talking about how it could be the next, 3 to 6 months before we actually see things turn in favor of emerging markets. I wanted to get a comment on worries about the government's latest demonetization move. What's it that you can tell us as far as, what it is that foreign investors are saying about this move? Do they see this as a short-term disruption, but only for long-term gains?
I think generally everybody is of the view that it could be good long-term, but short-term, given India was one of the most overweighted markets for most emerging markets, even global funds were quite actively overweighted India. They've seen this as an opportunity to trim and sell because they think there will be short-term pain and considerable amount of short-term pain in the consumer discretionary segments of the economy, and valuations aren't great in that space. So they are using the take profits and then maybe relook come back when things look more stable and the economy and the demonetization effects on the economy seem to have stabilized. But yeah, I think India is the place where people are taking profits at the moment.
Priya is joining in as well. Priya, let's talk about, the dollar. The 25 basis point hike was more or less baked in. What perhaps has surprised some is the fact that the Fed has said that it actually sees 3 rate hikes next year versus the 2 that they had forecast in September. Do you suspect that is going to fuel a little bit more of the strength that we're seeing in the dollar? Priya? Okay. Priya, this is for you. Priya, are you there? Okay. Let's talk about what the expectation is from Ms. Yellen's press conference then. What is it that you will be sort of looking out for?
I agree with you that it would be nice to have her make some comment on the Trump fiscal policy. And I think she'll maybe make some reference to fiscal policy without saying something like she's integrated that into their forecast for 2017 and 18. So she may make some reference to it, but not much. To be honest with you, I think she's going to be saying pretty much what you see in the statement. She's going to be sticking to that basic theme, and that is that the economy is doing a little bit better. They expect inflation to move towards the 2% target, maybe even slightly above that 2% target in 2017. And the Federal Reserve, as she always says, being very cautious, being very slow about implementing policy, she's going to say it's going to be very data dependent. And I think even though they have gone from expecting 2 increases in 2017 to 3 increases in 2017, every strategist and every economist doesn't put a lot of stock in that. They all say to themselves the same thing as I'm sure you're saying, as Janet Yellen is saying, as every member of the committee is saying, that whether it's 2 or 3 is going to depend on the data. So we really don't know much. And I don't think we're going to get much from her, to tell you the truth. I think it's going to be more of what you saw in the statement. She will probably refer to the dollar, and the dollar is a real problem. That's the dollar, of course, is going to likely be stronger if indeed they do raise rates 3 times in 2017. That is a problem. That is a negative. That is one of the trade-offs of moving towards restraint.
You're so right, because, when we started out 2016, the expectation was that we'd see 4 rate hikes this year, and we all know that that didn't happen. But Punita, let's talk about the reactions for our Indian markets tomorrow. Again, we know that this was coming, yet do you suspect that we're going to see some jerky moves tomorrow?
I think that any movement in Indian market is going to be not so much because of what happens with the Fed policy, because our meeting already happened and the rates were not decreased. I think there was a wide expectation that interest rates would come down in India, but they haven't. And this just kind of supports that view that perhaps India isn't going to be cutting interest rates, even despite the demonetization. So I think that's a bigger negative that one has to factor in light of what the economy is going through in India. And the Fed isn't necessarily supporting that decision.
Priya back with us. Priya, we were talking about, the dollar's strength and what likely the fact that we're possibly going to see 3 rate hikes in 2017 versus the 2 that the Fed has said in September in 2017 will mean for the currency.
Right. So, our view is that it would be strong. I think we're waiting to see what Chair Yellen, how she clarifies this 3-hike move, because, frankly, the statement is not that different. The dots have certainly moved higher. The economic projections have not moved up much. So is the argument that downside risks are lower, in which case I think the dollar's already had the move. But if you hear from Chair Yellen that, yes, if we get fiscal easing, we're close to full employment, and that they would need to go faster, then I think the dollar has more room to go. I think interest rates have more room to rise, because the Fed is effectively fueling the divergence trade. That the Fed is absolutely hiking while the rest of the world central banks are still thinking about easing. So I think we'll get more clarity during the press conference. But certainly this is more hawkish. The U.S. rate market has reacted as if it was a much more hawkish statement than what we were pricing in with that 3-hike suggestion, because that's not what we had been hearing from the Fed really in the lead up to the meeting. And I'd say the data does not support them going faster. So the only conclusion you can draw is that this is because of the expectation of fiscal easing. And if she clarifies that, I think then the dollar has room to go. I mean, it'll become self-limiting at some point when it starts affecting the economy, but for now, because of lags, I think it can run some more.
If the dollar does have more room to go, then what does that mean for emerging market currencies, and especially the rupee? Is 70 then coming soon?
Right. So I think, it would mean especially against EM, and that's generally with some of the trade policies that are being talked about with the new administration. I think we were getting a little negative on EM in general. I think dollar strength would further exacerbate that. The question is, are we going to get significant growth pickup in the U.S., which can then have a multiplier to the rest of the world and can stop, some of that divergence idea, because then the rest of the world grows as well. I think that's really the big question. How much fiscal easing are we going to get that moves growth into sort of a different trajectory? I think for that we have to sort of wait to see policies. I don't think the dollar move so far is enough to hurt U.S. growth, because on a year-over-year basis, it's still not that high. So that's why I think this has room to go. It's negative for EM right now. May not be negative for EM. If we do get a big boost in the U.S., then I think that does help through the export channel. It can certainly help EM as well.
Punita, I'd like your thoughts on that. Isn't that a good thing? The fact that you're seeing a good U.S. economy, it basically means it's also very good for global growth in a sense. So, it's only a matter of time before, you see the rub-off effect on other economies, isn't it?
Well, it depends a little bit on President-elect Trump's policies, because if he starts setting up new trade agreements with certain countries who are exporting to the U.S., then they both might be negatively impacted if they are not able to export at the rate which they do currently. So I don't know if it will have a ripple effect on global growth the way it would have in the past under this administration. And the second thing to keep in mind is that his focus is also to support manufacturing in the U.S. And so manufacturing-oriented economies might again get negatively impacted if they see manufacturing shifting back to the US from the global companies. And the third thing that this may not have a ripple effect is obviously what the currencies might do in the wake of all of these changes. And then, of course, his political alignment is yet to be, it's unclear, a bit unpredictable as to which countries he's going to align himself with. And the recent trends are pointing to maybe not supportive of China. So that's a big contributor to global growth, and that might be negatively impacted.
Priya, what about China? What's the fallout of this rate hike going to be on the renminbi? And I'm asking because, we haven't forgotten the capital outflows that we saw in late 2015, early 2016.
Great point. And I think that's the comparison between last December that's going to come back a little bit in the forefront with this hawkish comment, because this is somewhat similar to last year where we were pricing in 2 hikes and the Fed kept talking about 4, and now it's 2 versus 3. So our view is China, I think, has done a much better job with managing capital outflows so far this year, even though the dollar CNY has moved a lot. If you look at renminbi against the broader index, it's actually been fairly stable, which is not what it was like last year, where it was depreciating against the broader basket as well. So I think the authorities have sort of seem to have more control over the renminbi. But I'll be watching the renminbi against that broader index, and if that stability does seem a bit shaky, I think then fears will come back. Certainly, dollar strength is not something China wants because it's somewhat of a pegged currency, so the renminbi strengthens as well. So they will try and push back against it, and it becomes a very political issue with President-elect Trump bringing up this China currency manipulator. So it's a highly uncertain event. I think the key to watch will be how does the renminbi react against the trade weighted, and stability there I think will let the market ignore it. But any depreciation against the bigger basket, I think, could create sort of a ripple effect into global financial markets similar to the first quarter.
Okay. For the first time, you've seen a Republican administration in the US sort of controlling all 3 levers, whether it's the presidency, the Senate, and even the House. I'm just wondering if there is a likelihood that we could see them sort of impinge on the Federal Reserve's independence.
That's a worry, but by law they can't do that. There would have to be a lot of constitutional changes for them to jeopardize the independence of the Federal Reserve. From time to time, we've had lots of talk about that from Senator Paul and lots of Republicans and lots of Democrats, repeatedly trying to say, look, we've got to do something to either audit or reduce the independence of the Federal Reserve. The Federal Reserve has correctly resisted it successfully, and I cannot imagine us getting the kind of legal constitutional changes that would jeopardize that. So yes, it's going to be an issue. Yes, it'll show up in the newspapers, but it's unlikely to see any change that reduces the independence of the Federal Reserve. That would be a big mistake on the part of policymakers, and everybody knows it.
Okay, we've got time for just, closing comments, 7 minutes to go before Ms. Yellen does speak. Punita, I'll start with you. Do walk us through what it is that, you'll be sort of looking out for in her press conference, and what will be relevant to investors in India.
I think a couple of things. One, I believe personally, from whatever I'm seeing, that unemployment is actually fairly low, and the economy here seems to be doing quite well. So I'd like to see what comments are in that regard, whether her data actually supports the anecdotal evidence that one hears and sees, as that will drive why she might raise rates 3 times rather than twice next year. So some clarity on her views on the economy and why it's changed from the past 6 months is going to be quite important. And I think that will, my impression is that for emerging markets, I don't think this is a widely unexpected move, and it's probably unlikely to have any major impact on emerging markets that isn't already reflected in what we're seeing in market performance.
Right. You talked about how she's unlikely to go down, what the Trump presidency means for the US road. But do you think, just like Punita, that she's perhaps going to spend some time talking about the internals of the economy, how they're improving? Because I remember the last time we heard her speak in November, she said that she felt the economy needed more room to run. And, perhaps it's reached where the Fed was hoping it would be in December.
Yeah, I think she's going to restate. She's going to restate that. She's going to state that the economy is doing well, that inflation is headed towards their 2% target, maybe a little bit above. That's not going to surprise anybody. I think, quite frankly, the Fed, that's obviously been pressing for some fiscal stimulus, what she should do is applaud the fact that there's a chance that we're going to get something in the form of tax cuts and spending increases. But as far as moving down, trying to quantify, trying to say something more specific about what the impact of fiscal stimulus or the Trump plan is going to be, I'd be very surprised to hear it. She might say something, but she'll pass pretty quickly. I don't expect, quite frankly, her to say anything that's going to change my view. And my basic view is, quite frankly, let's wait and see what the data look like, and that will tell us whether the Fed's going to raise interest rates. My guess is there's not going to be much to dissuade me from the view that the Fed will raise rates between 2 and 4 times in 2017, and that will lead to higher rates across the board. And that's the kind of environment we're living in. And yes, the economy will do a little bit better, but not so much better as that you can justify stock prices at current levels. They've gotten a little bit ahead of ourselves, as you suggested.
Priya, what about you? You talked about, a little bit clarity on, what's fueling this optimism that we will possibly see 3 rate hikes in 2017. That's something you'd like Ms. Yellen to clarify. What else are you expecting her to address?
I think the overshooting idea, overshooting on inflation and undershooting on NAIRU. They've been talking about structural unemployment. Maybe we should push the economy to take the unemployment rate below that NAIRU level. Is that done? I think, have we reached the expiration date of that policy? Because then that implies that, we're at full employment. And this actually has a bearing on, if you do get fiscal easing and the Fed believes we're at full employment, then they will start hiking faster, because then it implies that inflation risk rises. And so any discussion around what does she think about slack in the labor market, I think will be important even as we go ahead into fiscal easing.
Right, Priya, you and Punita, all three of you, thank you so much for that. Just minutes to go before we hear Ms. Yellen speak. Let's recap the story for you. As expected, the US Federal Reserve has hiked interest rates by 25 basis points. Remember, till about 2 weeks ago, the odds of this rate rise were a full 100%. So you could argue that this was baked in, this was more or less in the price. So what have been the surprises? Well, for one, what the FOMC has said is that as things stand, it sees 3 rate hikes in 2017. Now, this is more than the 2 that it had forecast in September. So, of course, as our panelists said, that they would like to hear Ms. Yellen, elaborate on what's really driving this optimism as far as the Fed goes. What you're also seeing right now is the Dow that's hit a record high. Remember, it's really been a record running streak actually for US equities. So it's no surprise to see Wall Street behave like this. The Dow is within distance really of 20,000, and again, many in the market are arguing that this Trump rally, while it's showing no signs of fatigue, perhaps has run its course or is running a little ahead of itself. You also want to talk about what's happening with US 2-year Treasury yields. They've jumped to their highest since 2009. But this is, of course, largely because, remember, this is the first rate hike that you've seen in 2016, the second rate hike that you've seen in this entire tightening cycle. Let's also look at, the kind of picture that the US Federal Reserve is really painting for the economy. It's actually released a slightly rosier economic outlook, saying that it does see slightly faster GDP growth and lower unemployment. Remember, the jobs data last time round was a mild beat on all counts. You've also got unemployment that's fallen pretty sharply. So that's one area that, perhaps the US Federal Reserve is very comfortable with. Minutes from now, we will, of course, see Ms. Yellen speak. What does this really mean for our markets tomorrow? Well, at least our panelists seem to think that, you're really not going to see any jerky movements, and perhaps the pain has to do a lot with the domestic factors here at home. You also want to see what's happening on the dollar index, because if indeed you do see, the Fed forecasting those 3 rate hikes in 2017, that's only going to mean that you're going to see, more muscle being added to the dollar rally that you're seeing right now. Remember, the dollar index even touching a 14-year high earlier this month, and that in a sense, gives you a sign of what's really expected by the market.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.